NEOS just launched another covered call ETF. This one trades against gold. Is it worth buying? This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. For ages, gold has been the gold standard as to where to park your money to protect it in the event of inflation. And while gold typically does a pretty good job of preserving capital, it really doesn't do anything for your income. For the most part, investing in gold, whether it's your own physical gold or a gold ETF, has largely just been a way to preserve your capital but not add any additional buying power to your total portfolio. But if you're watching this channel, you're here to make passive income. And in recent years, covered call ETFs have largely been the way to fill that role. Enter today's ETF, IAUI. When you put your cash into IAUI, NEOS takes that cash and they put 25% of that directly into gold ETPs. Now, if you've watched the ETP video, you know that could really mean anything. It could mean ETF, it could mean an ETN, or any number of other instruments that are exchange traded. But typically, and with the current holdings, they are directly investing into a Goldman Sachs physical gold ETF, AAAU. The other 75% of the assets under management goes into a synthetic covered call strategy. The way they do this is first they park that 75% in US Treasuries, which they then leverage to sell a put. That put is for a longer expiration, and they use the premiums from that put to buy a call for the same expiration. Typically, these are going to be longer expiration dates. And between the date they buy it and the day that expiration hits, they're selling shorter expiration calls for income and to pay their fee of 0.78%. As for whether or not this ETF is going to perform, that depends largely on what they trade against and what they hold direct shares of. If we look at the holdings, they made an interesting choice here. They've chosen to hold AAAU, which is a Goldman Sachs physical gold ETF, but they trade against GLD. The Goldman Sachs ETF AAAU has no dividends. It has an IV of about 16.33%, which is a 10th percentile IV, which usually indicates this is probably a little more volatile than that. But the expense ratio is 0.18% versus GLD, which is the State Street Gold ETF, has an expense ratio of 0.4%, significantly higher than 0.18 with AAAU. Also pays no dividends, but has an IV of 19.04%. Higher raw IV, but is a 73rd percentile IV, which means this is nearing the top end of its volatility. For those who are more experienced in trading options, you might wonder why they're trading against the lower volatility ETF, because lower volatility usually means lower premiums. Lower premiums usually means lower dividends. However, GLD, while it is the lower average volatility ETF, it is more widely traded and it's better known, so it's got more volume. More volume means it's easier and faster to trade into and out of a position, which means they can get their trades to go their way a lot easier, and there's more strikes and more expirations. As for the performance of each of these ETFs, they perform almost exactly the same because they both just hold gold, and so whatever gold does, these ETFs are likely to do. Now, because IAUI just came out on June 5th of this year, it's still too early to really gauge its performance, but to get an idea of what a gold ETF that does covered calls can do, we can look at some of their competitors. Starting with total returns on their competitors, GLDI, which is actually an ETN by UBS, it actually has a total return for the past year of 23.76%. GDXY, the YieldMax competitor version of this one actually trades more against gold miners or gold mining companies. They have a total return of 24.3%. Now, I threw in BAR. BAR is just an ETF that just holds gold. That's from Granite Shares. Their total return for the past 12 months is 43.46%, and GLDY, the Defiance ETF that trades against gold, is actually at a negative 1.45%. So as you can see, these ETFs do give you some dividends, but you are trading off some of that upside in total returns to get those dividends. But if that's worth the trade-off and you're here just to bring up your income through dividends, then let's instead look at their dividend yields for the past 12 months. GLDI has a dividend yield of 13.88%. GDXY actually has the highest dividend yield of the three at 42.41%, and GLDY has a 9.15% dividend yield. Of course, BAR, just being a gold trust, doesn't actually pay any dividends. Now, even though I threw in GLDY hasn't been trading very long, so it really doesn't have 12 months of data to go on, so it doesn't look as good as it probably will at the 12-month mark. But we can still look at GLDI and GDXY and see that total returns are pretty much in line despite the dividend yields being so different. So tell us in the comments, is IAUI a buy? Why or why not? If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.